Hey traders, this is Ron Haydat Market Tamer. Happy Sunday. Hope you guys are having a fantastic holiday weekend. As always, everything in this presentation is for educational purposes only. All right, we'll kick off here with the Dow ETF, the diamonds. We're going to do a comparison of dailies versus weeklies. Let's start with the daily. If I zoom in here on the diamonds, you can see we got right up to that 50-day institutional moving average, which I said is going to be our line in the sand. We close above it, all-time highs are the target. We close below it, we remain in this sideways range. Well, the 50-day finished at 265.17. The intraday high was 265.40. We were about 23 cents above it, but you know what? The bulls, after having a giddy start to Friday, they did not want to hold that long position at its highs into the holiday weekend. They wanted to take some profits. They weren't that confident. Is that anything to truly worry about? Nah, not really, because we're still in the box. They just weren't that confident. It's the bottom line. If I draw that box in here, you can see where we closed back inside the box. So on the daily charts, that 50-day SMA, that institutional moving average in orange, remains the line in the sand for the bulls to get above. If we take this to a 2-year and then I change to weekly, look what happens. I'm going to get rid of the box and look where we finished. We finished the week up. We're back above the red line, which is the 20-period moving average on the weeklies. From a technical perspective, the bulls have the edge on the weeklies, and the 50-period held. So now we have a little bit of, we had some caution going into last week because we lost the 20 period. Well, this week we regained it. So dailies heading into September, bearish. Weeklies technically are bullish. What does that mean? Caution. Weeklies take a full week to finish. The fact that if you go to a daily chart of the Dow and we are still below the 50 period, it just tells you caution is still warranted. I would not want to be too bullish until we get above the 50 period. And keep an eye on, if you're going to trade the Dow ETF on the diamonds, 255 would be an alert level. If we go to the S&P, the spiders, similar situation. Again, you can see where the orange line is. We got above it here too by a couple pennies, finished in the lower half of the day. The bulls just weren't that confident. Volume was light, but that was to be expected heading into a holiday weekend. The box here too remains in effect. Watch the 50-day. We get above 50-day, it's bullish on a closing basis, or watch that 282 level on the downside below there, that's bearish. If I show you a weekly chart, this is 2-year daily, let's just make it 2-year weekly. Similar situation, right? There's the box on the dailies, and the weeklies were back above the red. Bullish on the weeklies. We go to the Qs, we'll start out with the weeklies. We're above it, and if I take you to a daily, stone cold stopped. Again, we got to get above that 50-day. So I'm not gonna go over all the finite details there. You get the idea. Now, if we go to the IWM, the Russell 2000, remain in this downtrending channel. The Russell 2, if I zoom in here, we even broke that little trend line that I had drawn in, closed back below the red line. So the target is still down here. Now, these guys need to get all the way up there before their chart would go bullish on the dailies. And then if I make this a weekly chart, again, you can even see the weeklies are down. So the IWM is still underperforming. There's no reversal, if you will. And please watch 145, just as even for the broad market. If the Russell closes below 145, we've breached this little reversal pattern right here, these opposing candles, and the target's all the way down here. Not looking good. All right, now let's take a look at VMware. I want to bring this one in because the question was, if I go to a daily chart, let's do 1-year daily. After this big rally from January all the way up to 205, it almost doubled its share price. Now we've given a lot back, right? But the question is, does this particular rally have any legs? And I could do something like this and say, hey, we're still in a downtrending channel. If you're watching VMware, or any stock for that matter, it might look like, hey, we have 3 nice up candles here, but look at the volume. Only Friday did it really get above the other days. So previously, in the last little trek up here, it almost looks like it's stair-stepping down, right? We had some decent volume, but then it burned out on earnings. Well, here we're having it again, bigger volume Friday, but we also came off the highs. So here's what I would look for in a stock like VMware. It's got to, in a pattern like this, it's got to get above the red line. That's the first sign the bulls might be getting some strength. Then I would go back to the 50-day. Now, of course, we can say, okay, above the red line, we can try gap fills, etc. But given how it's stair-stepping down, this is still firmly bearish despite the little 3-day rally where it's up like $10 since Wednesday. It's got to get above that red line. Here is Dollar Tree. This stock's had an interesting move. We gapped up on Thursday, finished near the lows of the day, and then Friday we moved higher. Big candles here opposing each other, but the bottom line is above the 50-day on Dollar Tree, then we can challenge up to 112.50, which is about 10% move on the dailies. Not saying it's going to do that, but that's what we need to get above from a technical perspective. How about WDC, Western Dig? This is a 1-year chart. And we had a pretty good sell-off May into June. It bottomed the beginning of June. Then we had our rally right back up, and now it's just chopping. When I see a previous high and a lot of chopping back and forth going nowhere fast, and this stock, notice, really didn't sell off in August. It basically just went choppy sideways. I went out to a 2-year chart because I know I talked to you guys about this one once before. Now this is where it gets interesting. We have cleared the April high. We did that back here in the summer, July and August. Pretty much at this stage, the target would all the way be up here near 75 bucks. If I zoom in here a little closer, you can see how we hit the 50-day on Wednesday and we're pushing higher. Pretty much a close above 57.50. That would be a little breakout from this consolidation pattern, and the target's all the way up there. So keep an eye on Western Dig. ULTA got ultra hit. There were reports of a profit warning. Wow, did this thing get taken out behind the woodshed? So it closed the previous day in the upper 330s. You're now in the 230s. This is a $100 drop. This is insane. There is shelf support here at 230. We break 230, then there's another little price gap down into the low 200s, 205-ish or so. Still very, very bearish. Hindsight's always 20/20. The stock did start to lose moving averages, tried to get back above them and couldn't, and then, man, opened the trap door and down she goes. And then here is XOP, which is the oil and gas exploration ETF. Question was, what would a turnaround look like on this? Well, I would take you to the 50-day. Why? Because the orange line was resistance here in July. It was also here at the end of July, beginning of August. So if this thing's going to make a turnaround, because I know oil and gas stocks have been beaten up, not all of them, but many of them, it needs to get above the orange line. So that is it. There'll be no video tomorrow because the U.S. markets are closed, not unless something bizarre happens in overnight trading and stuff on Monday. Bears have the edge in the daily charts still, but a close up, let's say on Tuesday, and we get above the orange line, target would be the all-time highs. Okay, wish you guys a fantastic holiday and a week ahead. I'll see you in the next video. Take good care.